Welcome to the Traders University, Mechanics of a Foreign Stock Transaction. Interactive Brokers allows its customers to trade multiple asset classes in many locations around the world. IB also permits investors to choose from one of 11 base currencies when deciding the primary funding unit for their accounts. Interactive Brokers has devised two possible methods for those customers wanting to buy stocks in companies domiciled abroad or whose shares trade in currencies other than the base currency the customer has chosen. This tour is designed to help illustrate both methods. Now, let's get started. Investors buying shares of any company typically hope for capital appreciation and dividend income. For a U.S. resident buying shares using U.S. dollars, there is no currency exchange risk to the investor. But what if the investor wants to invest in a company whose shares are trading on an overseas exchange, in a currency other than the U.S. dollar the investor is accustomed to using? Interactive Brokers has devised two solutions to help investors trade in foreign stock markets. These are the currency conversion and IB margin loan methods. This tour will work through the mechanics of each method and view each transaction from a variety of perspectives in an attempt to cover as many possible angles to illustrate the risks and rewards involved with each method. Before execution of a trade in shares of a security that will be settled in a foreign currency, IB's proprietary technology, known as the Credit Manager, checks a client's margin account to verify whether a credit balance in the settlement currency exists. If it does, that credit balance is used first. If not, IB automatically creates a loan in that currency to cover the settlement value of the transaction. In other words, two separate methods exist for dealing with non-base currency settlements. Customers either conduct a currency conversion or they are dealt a margin loan. For a cash account, the procedure is different because it is not permissible to make loans within a cash account. Clients must deposit sufficient funds within the foreign currency account before the account will successfully permit the transaction, or must make a currency conversion transaction first, bearing in mind that a currency settlement for a cash account is 2 business days. Let's deal with each transaction separately, starting with the IB margin loan, which allows a customer to buy a stock denominated in a currency other than that in which the account is based, without having to make a separate currency transaction. Having identified and located the stock ticker on the overseas exchange, the order entry process is the same as for domestic stocks. The customer can choose the number of shares and determine the price to be paid along with what order type to use. When the customer is ready to submit the trade to the exchange, he or she verifies the trade details on the trade ticket and can hit the transmit button. The credit manager at this point determines that the account does not have the foreign currency balance to support the trade, but that funds are available in the base currency to support the settlement of the trade. In order to facilitate the trade, Interactive Brokers automatically generates a margin loan to the customer to cover the entire amount of the foreign currency needed for the trade. The buying power of the remaining account balance in the base currency is reduced to reflect the use of the funds to support the loan in the settlement currency. The currency sub-account used to permit the trade now reflects 2 items. First, it shows the value of the purchased stocks in real time. Second, it shows a loan balance to reflect the funds borrowed on margin from IB. This is shown as a negative value in the cash section. The investor will be charged the prevailing rate of interest, easily viewed on Interactive Brokers' website under the Interest and Financing section, located under the Costs tab. IB charges some of the lowest margin rates available. The margin loan remains open until the customer sells the shares, at which point the proceeds of the sale are automatically used to repay the loan. Depending on what happens to the share price between the times of purchase and sale of the security, there may or may not be enough proceeds to fully repay the loan. If there are insufficient funds, the balance of the loan will remain open until the customer decides to pay it off in full. The margin loan is taken out at the prevailing exchange rate at the time of the stock transaction and the loan amount is made in the currency used to settle the underlying stock transaction. Using an IB margin loan removes some, but not all of the exchange rate risk because the loan is made in the currency in which the shares are traded. However, customers can take on the exchange rate risk for themselves in one of two ways by using the currency conversion method. First, investors could buy enough foreign currency to buy the number of shares they want ahead of time. This currency would be allocated to a sub-account within the customer's account, and the prevailing interest rate would be applied. The customer could hold on to this currency indefinitely, could sell it in order to earn a profit should the rate of exchange move favorably, or could use it to buy shares denominated in that currency. Alternatively, investors could attach an FX order to the underlying stock transaction when buying shares. By doing this, the share execution generates precisely the right amount of foreign currency to settle the transaction. Because of the time taken between the order entry and the execution, the settlement amount might differ by a small amount due to the exchange rate change that might have occurred in that small amount of time. To illustrate the process of currency conversion, let's assume that an investor holds the sum of $15,000 in his or her Interactive Brokers account. The investor decides to buy 10,000 shares in a British company, UK ABC Corp, trading on the London Stock Exchange at £1 each. At the time of the trade, the exchange rate between the US dollar and the British pound is exactly $1.50. Such that £1 buys $1.50 US. Conveniently, 10,000 shares in this case will cost the investor £10,000 or $15,000 US. The investor decides to convert this precise amount by using $15,000 to purchase £10,000, allowing him or her to settle the share purchase in full in British pounds. Let's assume that after a few weeks of no action for the share price, the investor gives up and decides to sell the position at the same £1 per share, so no capital loss or gain results from the transaction. By selling all 10,000 shares, the customer now has a £10,000 account balance, which is of course in British pounds, not the customer's base currency. However, when the investor enters the reverse currency transaction to get pounds back into dollars, he or she finds that the pound has fallen against a stronger dollar, where the pound now buys only $1.40. Selling 10,000 pounds at $1.40 now only leaves the investor with $14,000, which means a $1,000 capital loss due to a rise in the value of the dollar while his or her investment was denominated in British pounds. Let's examine this same process in which the position was closed at the same price it was bought, but this time when the value of the pound rose against the dollar. The investor sells all 10,000 shares at £1 each, leaving an account balance of £10,000. But on this occasion, the rate of exchange has moved to $1.60, which means that the British pound buys more dollars than at the time of the initial transaction. So when the investor converts 10,000 pounds back into dollars, it produces $16,000. Or a windfall gain of $1,000 despite no change in the value of the underlying share price. In this case, the investor has benefited by holding a position denominated in British pounds, thanks to a weakening of the dollar. You should be able to see by now that the rate of exchange is a factor when making transactions abroad. Let's look next at the impact of the exchange rate on the outcome when the initial share investment gains in value. Let's say that the share price rises by 10%, at which point the investor is able to sell his or her shares at £1.10 each for a total value of £11,000. The investor has a capital gain of £1,000, but still faces the hurdle of repatriating the funds to the domestic currency. At an unchanged exchange rate of $1.50, the investor's capital gain would translate to $1,500 upon conversion. But notice what happens if the dollar strengthens to $1.40. The gain is reduced to just $400. But if the dollar weakens during this time to $1.60, the gain is magnified to $2,600. Let's revisit the same scenario, But this time we can examine the impact on the final outcome in the event that the share price loses value to 90 pence per share. At this point, the investor decides to take a loss of £1,000 on his or her investment before dealing with the exchange rate transaction. At an unchanged exchange rate of $1.50, the investor's capital loss would translate to $1,500 upon conversion. But should the dollar strengthen to $1.40, the loss increases to $2,400. But if the dollar weakens during this time to $1.60, the loss is reduced to $600. Using currency conversion method, the investor must understand the implications of both capital and exchange rate movements while investing overseas. Let's now review the same situations using a collateralized loan. In this case, the investor uses a $15,000 balance in his account to purchase 10,000 shares in UK ABC Corp, trading on the London Stock Exchange at £1 each, but the customer does not convert the US dollars to British pounds. In order to settle the transaction, IB loans the customer British pounds, but leaves the $15,000 account balance intact in his interactive broker's account. In order to fully settle the purchase of £10,000 worth of British shares, the investor needs to collateralize $15,000 at the prevailing exchange rate of $1.50. The customer may earn interest on the $15,000 deposited in his or her account, but will pay the prevailing cost to borrow £10,000. This spread differential may end up costing the investor depending on the structure of global interest rates. We can now examine the impact of a change in the share price on the customer's loan balance. Let's start by assuming that the investor sells the shares after a 10% price gain. A 10-penny rise in the price of 10,000 shares of UK ABC Corp would yield the investor a capital gain of £1,000 after the £10,000 loan balance has been repaid. The customer may also then convert that post-loan profit back to dollars at the prevailing exchange rate, which may be different from the $1.50 at the time the loan was originated. You can see how a change in the value of the dollar might impact the £1,000 capital gain. Assuming the exchange rate remains stable, the pound sterling profit becomes a $1,500 gain for the customer. Should the dollar lose value and fall to $1.60 per British pound, the rise is magnified to a $2,600 gain. But a rise in the value of the dollar to $1.40 per pound erodes that gain to just $400 upon conversion. If we now assume that the investor takes a loss of 10 pence per share, you can see that the investor will face the additional problem of having to find more capital to repay the original loan. By closing the position for a 10% loss, the investor realizes proceeds of £9,000. But the customer faces a £1,000 shortfall in paying off the loan principal. In the event that losses on open positions cause a customer's account equity to fall below minimum maintenance margin requirements, IB's real-time margin system may liquidate some or all of the positions in the account to limit potential losses to the client and to the firm. The customer now must find £1,000 to repay the loan from the dollar side of his or her account, and depending on whether the exchange rate has risen or fallen, will determine the exact dollar amount needed for conversion. The customer is faced with a rising commitment in the event that the exchange rate strengthens in favor of the pound and against the dollar. A 10-cent appreciation of the dollar to $1.40 per pound reduces the conversion required by $200 to $1,400 compared to the original $1.50 exchange rate at the time the original transaction was made. If the pound strengthens and now buys $1.60, the deficit increases by $100 to $1,600. Investors have two possible approaches to funding overseas stock transactions. As with any investment decision, investors face risks as well as rewards, and neither solution offers complete protection. Each has its pros and cons. Using the currency conversion method, the investor faces currency risk on both the underlying principal and on daily share price fluctuations. But by taking on the prospects for currency changes, the investor eliminates financing costs. Using a collateralized loan, the investor might remove the currency risk from the principal amount of the transaction, but might face a shortfall when repaying the loan in the event that a capital loss occurs. Daily P&L is also subject to currency risk with a loan on currency. In addition, the investor might also be subject to finance charges depending on the spread difference between the currency in which his or her account is held and that in which the loan is undertaken. Bank holidays can extend the settlement of forex trades, and the finance charges on the currency loans must be considered when computing the cost of trades across multiple markets.